Hello and welcome back. This is the cash flow from operating activities indirect method, also known as the reconciliation method. Now remember, this is just a resource to help initially students to understand the statement of cash flows. Remember, also keep in mind that explanations are overly simplified and therefore not totally correct if out in the practicing world. So net cash flow from operating activities is different from net income, and you can see on your statement that we're going to start with net income from our income statement, and then we're going to make some adjustments to that. These are non-cash transactions because our income statement is based on the accrual basis of accounting. You should remember that from Accounting 1. The statement of cash flow represents cash basis accounting. So we're going to analyze our cash. Where is it coming from and where did we spend it? This can help us or will assist us to forecast future profits and also maybe future financial hardships. So cash from operating activities reports the cash inflow and outflow from day-to-day operations. So we're selling products, we're collecting money from our customers, our cash from our customers for products and or services. So we turn around and use our cash collections to pay one for our employees. Could be a variety of different reasons why we or how we pay our cash collections in our day-to-day operations, but these are just a few examples. For example, we pay our employees, we pay a notes payable to the bank, we pay our suppliers, and various other transactions throughout the day that you can relate to your own activities and or experience or position right now. The indirect method reports cash flows from operating activities beginning with net income, so you can see that information on your screen. We will make adjustments to revenues and or expenses that did not involve cash. Non-cash payments and or receipts could be an example of signing a notes payable for the purchase of fixed assets or a building that is also an asset. Issuing stock to retire debt. Those are examples of non-cash payments and or receipts that we're going to have to reconcile back to net income initially to start our statement of cash flow. The indirect method operating activities starts on page 616 of your book. The first step is we're going to add back non-cash payments such as depreciation and amortization. You should remember in Accounting 1 where you did an adjusted journal entry at the end of the accounting period to make sure you have proper matching of revenue and expenses, such as record and depreciation expense. You would have debited depreciation expense, for example, depreciation expense truck, $1,000. You would have credited accumulated depreciation truck, $1,000. Okay, and your journal entry description would be something along the line to record 1 month or 12 months depreciation expense for the truck. Same goes for goodwill, same goes for depletion. Those were non-cash expenses that you recorded in your books before you closed out for the month or for the year or for the quarter, whatever it was. You're going to add those back. So that's the second line, plus non-cash expenses, depreciation, amortization, or depletion that you see on your screen. Next, we have to look at gain or loss on sale of fixed assets. So gain or plus or minus gains or losses on investing or financing activities. For example, gain or loss on sale of fixed asset. It is true that a sale of asset is an investing activity. However, since the gain or loss has been reported on the income statement affecting net income, on the statement of cash flows, the adjustment to net income for a gain would be deducted from net income. On the statement of cash flow, the adjustment to net income for a loss is added to net income. So in your notes, you can also put or add that these items will also be part of your operation activities on your statement of cash flow. Interest paid on debt, and that's because the decision that we used as a company to finance some type of purchase or expansion, yes, it was a financing activity, but once we start paying the interest on this debt, it comes from our operations, right? So the interest that we pay is going to be included in the operating activities of our statement of cash flow. Interest received on investments or dividends received on investments, the decision to purchase a debt or equity investment, which was in the last Appendix D chapter that we did, yes, it is an investing activity, but once we receive the interest dividends or the interest income, we used it to operate our business. Therefore, it's going to be reported in the operating activities on your statement of cash flow. Okay, so next we're going to look at changes in current asset, current liability accounts relating to our activities, and it's on the balance sheet. So that's step 3. If you look on page 617, changes in current asset and current liabilities. An increase in a non-current, or let me back up, an increase in non-cash current operating assets. These are deducted. A decrease in non-cash current asset are added. So let's look for an example of that. We made a sale of $10,000 on account. Okay, so we have the sale recorded in our income statement, but our customer didn't pay us. So it's recorded as a sale in our income statement. However, on our balance sheet, we have a debit to AR, right? We didn't receive cash. Our income statement is accrual basis accounting. Our statement of cash flow is a cash basis accounting. Therefore, on your income statement, the sale affected net income, right? It was a non-cash transaction, so it was an increase in AR. We need to do an adjustment on our statement of cash flow as a deduction from net income. Okay, so take a moment to process that just a little bit. Okay, so now let's look at liabilities. An increase in a non-cash current operating liabilities, these are going to be added to net income. A decrease in non-cash current operating liability is deducted. So you can see on page 617 and 618 various transactions and how our book or our publisher is going to try to help you understand why we're looking and how we're going to apply a deduction or a payment back to net income, and how we're going to reconcile that as we're doing the statement of cash flows. Okay? So the following information has been provided from Cengage and the publisher of the book. You also have all of this information on 616 through 625 as well. So they want you to kind of go back to the core accounting equation, and then you're going to kind of look at these non-cash assets and how this can change, or how it might help you to understand as you're going through the statement of cash flow, how to apply these, whether you deduct from net income or add to net income. So this is also part of your extra resources that the book has provided for you. Additional resources, as you can see on your screen, you're going to start with accounts receivable is operating, inventories is operating, investment is investing activities, land is investing, equipment, and you can read on down through there. Accumulation is amortization, and depreciation is not only part of our reconciling information in our operating, but also investing. So we kind of talked about that. Again, pages 616 through 625 give you much more detail. This is just a supplemental of information that might help you picture and be able to apply the rules and theories in order to complete the statement of cash flows. Again, additional information. When you see an increase in inventory, when you see a decrease in inventory, the book is trying to explain why and give you a little bit more of a hands-on understanding of why you would add and why you would deduct. So you can read down through these as well. Prepaid expenses, increase, decrease, increase, accounts payable, decrease, increase, and how it affects your statement of owner's equity. Next, we're going to go through an example, exercise 13-16. We'll also be doing this in class as well. Okay, so this is exercise 13-16, page 646. National Beverage Company. We're going to complete the operating activities for the statement of cash flows for this company. The information is given to you, the income statement as well as the balance sheet information. So to begin, we're going to start with net income, which is given to us. It is the $49,311. The rest of the information for the income statement is kind of streamlined, but we have depreciation expense. We know that we're going to add that back. gain on disposal of property, and you can see that the comment popped up and said enter any kind of gain or loss that requires a negative to be entered as a negative. So here we're going to subtract from net income $1,188 as a gain on disposal of property. Again, streamlining the information, they give us other items involving non-cash expenses. Expenses we're going to add to net income. The rest of the information as far as the net change in operating assets and liabilities is given to us on the balance sheet information given to us in the problem. Now if you'll look right here, I've added just a little bit of road mark. I'm trying to assist you in understanding when you first see this, an increase in accounts receivable is an asset. Increases are deducted. A decrease in inventory, which is also an asset, is a deduction. So you're going to increase accounts receivable, so you're going to deduct from net income. A decrease in inventory is a current asset. You're going to add. Now the rest of these are liabilities, so if it's a decrease you deduct, if it's an increase you add for liabilities. So you have a decrease in prepaid expenses as a liability, you deduct from net income, deduct the decrease in accounts payable, and you deduct the accrued current and other current liabilities as well. So here you should be able to calculate that you have a net cash flow from operating activities in the amount of $58,020. So the second part of this question or this exercise wants to know, how do you interpret these results? Well, at this point in time, it's like I don't really know how to interpret, but if you go back here and look, your net income is positive, so that looks like they have positive earnings. And look right here, they have positive net cash flow from operating activities, so that seems to be pretty healthy. Both of them are positive, so it looks like they're doing well. And again, looks like the company might be growing. It looks like they have more sales recorded than they have collected for AR, which is okay. It's just a timing difference. So it looks like they're increasing, and it's a positive sign. Again, if we go back to the publisher's information, just showing you some of the decreases and increases in assets. This was also shown in the previous clip, but just to show you how to interpret some of this, and this is something that you're just going to have to practice.